Let's bring in Hatem Dhiab, managing partner at Gerber Kawasaki, for some perspective. Hatem, you've got high rates that tend to clip the Nasdaq sector and tech stocks in particular, and you've got regulators that are sharpening their knives. What does this mean for the trajectory of tech stocks going forward?
Hey, good morning, Amber. Good to be on. Yeah, absolutely. I think the high rates actually is a bigger problem, I think. You get decelerating growth, and high rates are usually really bad for tech stocks because valuations have to compress. With the regulators, I really don't. I mean, I think Lina Khan and the FTC have been trying to rein in big tech for a while now, but they haven't really been very successful. And the last lawsuit with Amazon doesn't really seem to have too many legs. I think reducing prices for customers is what Amazon has done very well. So I don't know how well they're going to prevail there.
I mean, this ongoing theme that any of these companies should be broken up, though, isn't going away, despite, that there aren't a lot of wins under the FTC's belt on this front.
Yeah, absolutely. I think it creates more of a risk for these companies, or at least a culture of fear where they can't make any acquisitions. But ultimately, I don't think the FTC has a very, very good argument to be able to break up Google or Amazon, at least based on the arguments they're making today. Consumers are actually benefiting from Google's, low prices or advertising. I mean, everything that Google does is basically free for customers, and same with Amazon. They really brought prices down for everyone. So I'm not sure I agree with the FTC here.
Okay, so if regulation isn't stopping you from stepping in here, is the interest rate environment getting you to be a lot more selective in the sector? I mentioned the Nasdaq is pretty close to an official correction territory that is a 10% pullback from its most recent peak. Do you think there's further downside?
I mean, seasonality also plays a role here. Summers are always really tough, or at least slower for the markets. But yeah, absolutely, rates have been really the biggest story all year. I think the Fed is done or almost close to being done. So if that's the case, if that's true, we will see stocks or tech stocks especially really take off from here. So I'm not really too much worried. I think everyone is trying to see what is the bigger damage that this massive increase in rates has done over the last year and a half per se.
So if you're a buyer here, what's showing up on your shopping list?
Well, I think you have to have a long-term view, right? And you look at this generative AI story that's just starting to play itself out this year, and it's really massive because we've never seen a technology that impacts so many different sectors and areas at the same time, right? We're still in the excitement phase, and we're entering the building phase. Building phase meaning that a lot of companies are trying to figure out how this is going to be advantageous, or how they're going to invest in this space, right? So right now is really by the infrastructure. So like companies like Oracle, Microsoft, Google are really good places to be, because that's really who's benefiting from this new trend.
I'm glad you brought that up. And now you get a little bit of a pullback here, right? Like Oracle's been on a tear for the past year, but following its most recent set of results, it has also slumped to a 4-month low.
Correct. And as an investor, you have to look for pullbacks as opportunities, right? With Oracle, you're getting a really kind of an infrastructure play. Oracle is moving from database to provide infrastructure for these generative AI tools. They have great relationship with Microsoft and NVIDIA, but also at a massive discount to where they were trading just 3 or 4 months ago. So I think if you like the space, if you like the story, this is a good time to jump in.
Well, I'm glad you brought up NVIDIA, because that one has also pulled back after earnings. It's down about 15% from its all-time high, and almost all of that is after its blowout quarter. Right.
Again, I think the story is seasonality and really rates. But again, the story for NVIDIA is, and they're like really the only company that is making a real money, a lot of money from generative AI. We're talking about, they're growing 50-60% quarter over quarter. So I think if you don't own this company, you have to own it long term.
One stock I'm surprised hasn't gotten more of a bid or hasn't proved as resilient as Tesla. We talk to you about this one all the time, not only because, there's a lot of interest on artificial intelligence, but also because, with this auto worker strike, so many people view Tesla as kind of a long-term beneficiary of this.
They are, right? Because they don't have any, none of the Tesla workers are part of the UAW. I think the demands of the UAW may bankrupt Ford or GM at this point, and Tesla would be the biggest beneficiary of this. But ultimately, I think, again, high valuation stock that was trading at, and obviously the fact that they were reducing prices has put some pressure on their margins. So I think that's why you haven't seen a bid. But long term, Tesla's model is kind of the winner here.
It's interesting you say that the demands of these auto workers are going to bankrupt General Motors and Ford. I mean, these are companies that are still growing at a healthy clip. Demand for their cars has been very strong, and they are working on investing and innovating in electric vehicles.
Well, the problem is a lot of the auto workers that they have are part of the legacy kind of part of their business, and they're all trying to move into the EV sector, and that sector is just not profitable, right? So I think there is a skills issue here too, where they have to invest in more kind of battery manufacturing and EV building. So there's an issue that they have to work through, and if they have to pay employees 40% more and only work 32 hours a week, I think we're going to have a problem.